I love it. Well, welcome. We got more people jumping on, so welcome everybody. It's good to have you guys. I gotta say, it's good to be back. If you all, I don't know if any of you all are in Florida or in these parts, Tennessee, North Carolina, parts of Georgia, but we got hammered with all these hurricanes. So it was twice, it was back to back. They were 2 weeks apart. That's nice, Greg. Thanks for showing me a picture of you fly fishing. We appreciate that. Thanks. But that is pretty cool. But anyway, yeah, we got hammered back to back with all these stinking hurricanes, and they just so happened to hit on a Thursday, and that's when we have our call. So I'm like, really? That's not right. That's like super not cool. So the last one I was here for, I stayed for one, and then my wife and daughter were gone to California. And then the second one, yes, thanks, Amber. We are okay. The second one, we just were like, we're getting out of here. So I don't know if you guys know, but we have like a schoolie. We converted a bus. We converted it into one of those schoolies. We call it the beach bus, and it's an Airbnb actually out here on our property. We just took that. That's like our getaway vehicle. So we took that, headed for the hills, and stayed up in Georgia for like 3 days and came back down. So anyway, but it's been a mess. We're still cleaning up out here. Got lots of stuff going on, but it's just good to be back. So I just wanted to say a couple of things. One, it's good to be back. Number two, we are almost at a year of doing this call. So for those of you who've been on for the whole time, there's a couple on here. That's awesome. I mean, here's the thing, like we started this thing on just a post that was on Circle, and everybody was like so interested in learning how to raise capital. And so they all thought that I was some capital raising expert, and I'm not. So for all you that are on here and you're on this show for raising private capital and you're like, oh, Jeff's the expert. I'm not the expert at all. I've been learning this whole year. And Kevin here is on this call is going to be talking here in a little bit. He is, I'm going to say it, Kevin, you are an expert. You're an expert. So anyway, with that said, this year, the whole point of this was to teach each other, all of us, how to raise capital, support each other, get behind each other. We have the WhatsApp group and stuff like that. And there's been so many comments and posts on there. It's just blown up. And so many people have poured out their love and care on other people and helped other people get to where they want to get. And that was the goal. So I could say one thing for my wife and I, we currently just wrote up an offer, and it's on 4 separate self-storage units in 3 different states. And we put an offer in on it, and we're raising the capital right now. We've had multiple calls with different investors to raise the money. So that's amazing to us. We're just like besides ourselves. But I got to tell you guys, that's props to a lot of you guys. Props to you guys showing up, being on the show. All that stuff has been a huge support to us. And it just shows, right? Like we put in the work and the time, and guess what? We get something out of it. So super stoked on that. So without further ado, we're going to get on the show or get into the show here. And guess what? This guy over here, I don't know if you guys see him here, Kevin Thueson, and I'm probably not saying that right. He said his name is a mystery, but I was like, my name is longer than your name. So it could be Thueson. I don't know how else to say it.
Well, I say it Thueson, but you can say it however you want.
Okay. Well, yeah, Thueson and Bodenmuller is how you say my name. It's German. Everybody says Bodenmuller, and it's supposed to have umlauts over the U. In German, that's what they do. And when my dad came over here from Germany, he did not want those put on there. So it's Bodenmuller, but it's actually Bodenmuller. So whatever. You can say whatever you want. Anyway, so we're going to start this deal out with a teaser. And I told you guys about this. This is pretty awesome. This whole group, by the way, is member led, right? Better Life is super cool. And they let us do this on our own, right? They support us. They give us the Zoom call and stuff like that. All you guys that are on here are Better Life members. And this whole call is member led. So they're just like, go ahead, do your thing, right? So that's pretty amazing. A real good perk of being on Better Life. So with that said, Mr. Kevin and I here are working on an event. So we are going to do the very first member-led event through Better Life. And this event is going to be something y'all, so I'm sure you guys, a lot of you people on here have been to Vegas, or you've been to a couple events, you know, the Better Life Summit or any of that stuff, and they're super fun. Like I absolutely love them. I was talking to Brandon about that, and I said that's one of the coolest parts of Better Life is the community aspect of Better Life. All this stuff is amazing, but those events are great. We meet so many good people. It's just a great time to get together and really actually get to meet each other, right? Like these calls is good too, but anyway, one of those things I don't like about the events is it's hard to bring your kids, or it's hard to bring family, right? So all you out there with little ones or whatever, it's hard to go to those events because you got to have someone watch your kids. You know, it's just tough. So I was talking to Brandon about this, and I'm like, we need to do like a kid friendly or family friendly event to where we can bring our kids and still learn about real estate. And also, I feel like this is very important, teach our kids the same thing, right? Because for us, for the reason I do this too, is I'm trying to pass this on generationally. I'm trying to move this on to my children and stuff like that. And I want to teach them how to do these things. So we are putting together an event in Arkansas, and it's going to be a camping event. It's going to be like the coolest thing ever, and it's literally going to be a mastermind. So we're going to be working while we're there, but you can bring your kids. Kevin, and he's going to talk about this in a little bit. He invests in campgrounds, so we're going to be using one of his campgrounds, and we are setting this whole event up. We're going to go on little trips and go out to lakes and different parks and stuff like that, so we can all be together. And we're going to cook together. We're going to do like dinners and lunch and breakfast. You know, maybe the men will cook the breakfast, whatever. So there's going to be all this stuff set together as a group of people with our kids. So it's just going to be, I feel, better than going to Vegas. No offense to BLT and all those cats, but it's going to be better because it's all going to be about just hanging out with each other and our kids and getting to know each other on a different level. So anyway, that's the teaser. Kevin's going to talk a little more on that, and then he's going to get started on his whole new deal he's got working on. So Kevin, let's hear it, brother.
All right. I won't add much to the teaser, but the idea behind it is, like Jeff said, I've been to a lot of events. And I'll talk about this. My business, we invest in campgrounds, and currently we own a handful of KOA franchises. And KOA's annual convention for franchisees last year was in Vegas. And so went down for almost a week, and for like 4 days, I didn't get outside of the convention center or the hotel. You know, they design all that to where you're stuck inside, and actually getting outside is difficult. And so the idea, like the event was great, but the idea behind this is like, let's get outside. Let's spend time in the outdoors. Let's do some adventuring, see some things, and sprinkle in a mix of activities, real estate learning from each other. But the real intent is like, let's just get to know each other. Let's network. How can we help each other? What are those opportunities? And those are the types of events that I've taken the most from. So that's what we're trying to do with that. And we'll have some more information with specifics on where and when and what it'll look like, et cetera. That'll be coming out soon. But we're gonna keep it to a small group, one, because we don't know how many people really actually want to hang out with us. So we're gonna start small. But you know, depending on how well it goes, we may continue to do it and do it bigger and open up to more people or whatever. So it'll be a small, intimate group. It'll be a good time, camping and talking about real estate and meeting other cool, like-minded people. So
Yeah, and the other cool part of that too is, I didn't really say this, is the cost. Because some of those bigger events, they're expensive, and then it's not even including your food and your lodging, and we all know how that can get crazy. So you guys will be super surprised when we release everything and see the cost on this stuff. So Kevin's done us a solid on deals for cabins and places to stay. So it's just going to be, yeah, I'm ready for it, man. I'm ready for it. So anyway, but first we got to hear from you. So go ahead, tell us what you got working.
yeah, well, we got one question in here in the chat that I'll answer. So we're planning on the first week in March. Couple of things there is, one, trying to deal with the weather where it makes sense, but also we are trying to plan it far enough away from the Better Life REI summit in May so that people who want to do both can do both. So March 5th through the 8th is the date that we have planned, and it'll be in Hot Springs, Arkansas. So stay tuned for more info on that.
Yeah.
All right, so let me start with just I'll try and keep it quick, background on me and who I am and how I got into this, what my story is, and hopefully that is helpful, resonates with some of you. So my original career was in accounting. I graduated with an accounting degree and went into public accounting as an auditor. And I did that for 10 years with PricewaterhouseCoopers. I lived in Washington, D.C., and then transferred to Seattle. And my job was auditing financial statements. And I worked with private companies. So um, my client base was I had professional sports teams and landscape companies and government contractors. Um, and then when I moved to Microsoft, moved to Seattle, I worked on Microsoft and Costco and, some of these bigger company type things. So that was my career. And for the 10 years I was in it, I spent probably the last 8 years trying to get out of it, but I didn't know what to do, how to do it. And it was reconnecting with an old college friend that gave me a copy of Rich Dad, Poor Dad. That got me thinking about real estate. And one thing led to another. And I made the decision that I was going to quit my job and I was going to get into real estate. And in order to do it, um, I, yeah, thanks, Cody. I appreciate that. Um, I had to do it in my situation. So I'm going to hit my 20th wedding anniversary in the spring. I have two kids. My daughter's 18. She's a senior in high school. My son's 15. So I have two teenage kids in high school right now. When I left PwC to get into real estate, that was 6.5 years ago. And so I had a family. I was in kind of this point in life where I think at the time I might have had $2,000 in the bank. We lived paycheck to paycheck. I didn't have anything to say, well, I've got all this money. I can just go out and start buying real estate. Um, but I knew that I didn't have the patience to buy a duplex, convince my family to move into one side, rent the other, hack that for a couple of years, and then try it again and, take 10 years. So my my approach was, how can I do this in one fell swoop? And that led me into looking into different types of larger deals, commercial real estate. And really what it came down to was I really like the idea of combining hobbies and the things that I enjoy doing with work. And that's camping, that's outdoor adventuring, that's hiking, mountain biking, skiing, all the things that I grew up doing. And so um, kind of by happenstance, I found a property for sale in Utah where I grew up, and we'd been living away for 10 years, but wanted to move back to Utah. So right place, right time, right deal, seller financing, and it kind of all clicked into place that Campgrounds was going to be the thing that I was going to do. And part of what attracted me to it was not many people are investing in this. It's something a little bit different, but is very similar to mobile home parks or manufactured housing or self-storage. The principles behind it are very similar, fairly simple business. And so I sold my house in Seattle, quit my job, and then about a month after I quit my job, we bought a KOA franchise in Utah, and I moved into one of the little cabins, lived there for the summer while my family stayed in Seattle. And then they moved down in the fall and we moved into a house. I moved off the campground and hired a manager and ran that for a couple years. Did fairly well with it. Brought on a partner who was my high school best friend, college roommate, had been doing real estate in Texas. We partnered and did several deals. Um, we did several deals together in 2020, bought a couple of additional campgrounds. And then in 2021, we started KCN with a third partner. And that's when we started raising money to scale the business and go out and build a large portfolio of campgrounds and RV parks. So that's the background. Started really from the ground up as an operator. Like I said, I was living in one of the little cabins. I was cleaning toilets, answering phones, making reservations, selling stuff in the store, mowing the lawn, painting the buildings, trimming the trees, all of that stuff. And so learned it from the ground up so that when the time came and I actually had to go out and ask people if they were interested in investing with me, I could tell them, I've done it. I know what it takes. This is what it looks like because we've executed this. We understand the strategy and we've proven ourselves out as operators first before trying to be syndicators and raising capital. And that was a big thing for us, was being able to show that we understood the business. We'd done it before. Now let's scale it to that next level. So that leads us into 2022, which was when we first started raising outside capital. And we started, like most people, with friends and family. And my partners, Cam and Nate, had raised money for other real estate deals and multifamily and single family commercial deals in the past. And we started with that group and people we knew. And in 2022, we bought 4 parks and had raised about $8 million that first year. Since then, we've bought 2 more parks, sold one, and we have now our 9th park under contract to close in January. So when all's said and done, with the 8 parks we currently own and operate, we're about 15 million in capital that we've raised over the last 2.5 years. And this current deal will be about a $2.5 to $2.6 million raise that we're working on. And I'll go through the specifics of the deal itself just to show you kind of how we put it together, how we look at it, the materials we put out in front of our investors, and what that looks like. But what I will say is those numbers might sound high. To me, it doesn't sound that much because I look at what other people are doing and how much it is, but it just comes down to the deal. It's the deal finds the money, and it's our job to figure out how we get the deal in front of the right people. That's the trick. And that's not some mystery that we have solved. That's an ongoing thing. But one thing that we have been able to do that is we look at as maybe being something that's a little bit of a differentiator for KCN is we put together enough of a track record and a reputation and a culture within our company and what we've done to attract a family office investor. And earlier this year, we partnered with a family office out of Colorado where we sold. And the way we did this is, and I guess I can get into the details of this, our entity structure, but we sold a portion of equity in our management company. They funded that with the intent of we were going to use that cash that they put into KCN to go out and hire more people on our operations team to help us run the day-to-day operations of the parks. And then they set aside an amount of their capital to invest in future acquisitions. So it's really strategic partnership, but it came down to we had a product that was interesting. It was unique, good returns, especially when compared to other asset classes, because we're able to buy at high cap rates, 8, 9, 10 caps, and cash flow from day one, a lot of room for appreciation and growth. So that was attractive to them, but then also the unique aspect of being outdoor and adventure focused was appealing to this particular group and to a lot of people in general, right? Healthy lifestyle, something that is getting you outside into nature, away from screens, away from TV. There's a definitely a beneficial impact to getting outside in nature, whether it's hiking or biking or just being out in the fresh air. And that's a big part of what we're trying to sell to our guests as, the experience of staying at one of our parks. So that's a not so short background on us. And let me see, Cody had a question. SBA funding. The second 2 deals we did SBA loans. So the first deal that I bought was seller financing. and I was able to get in with fairly low down payment. And I say low, it wasn't an insignificant amount, but because I sold my house to pay for it, I was able to come up with that down payment on my own. Seller financing terms were really beneficial at the time. And then I did a cash out refi out of that seller financing note 2 years later and used the cash from that refi and brought on my partner Cam, and we did SBA loans for purchases 2 and 3, which was great because the low down payment requirements for SBA allowed us to buy 2 parks. Originally, we were only going to buy one. We had one under contract, and another opportunity came up, and we had enough that we could buy both as long as we were able to limit how much money we had to put into each. So those ones are a little bit higher leverage than what we normally do, but beneficial terms. What I will say is that SBA is really difficult to work with. That process was a pain, but sometimes it's the best and or only option. We're not doing SBA loans anymore, mostly because we don't have to, and because it gives us some flexibility to refi or get out of those notes earlier without some of the onerous prepayment penalties, and we can move a lot quicker going with traditional or conventional financing through local and regional credit unions and banks. So Ty asked, entity structure based on the product. So the way we do it is we have a property management company, which is KCN, that is completely separate from the deal itself. And then for each property we buy, we set up an investor LLC that all of our investors come in at as members on. They'll invest directly into that. We use Wyoming as the state where we do our investor LLCs, and there's a lot of background behind that. If any of you guys have gone through the research of how to do that, there's a few states that provide better protection and anonymity for people who are doing investing. That's why we use Wyoming. And then depending on where the campground is, we'll set up another LLC, what we call a holding LLC, in the state where the property is. And that LLC will be 100% owned by the investor LLC in Wyoming, the single member LLC, and it will take deed to the property. It will hold the loan for the property. And then we enter into a operating lease with KCN to run the park. So our investors are investing in real estate and then leasing out the land and everything they're buying to a separate entity that they have no affiliation with. And we run 100% of the operations through that. So all of our payroll, all of our employees, all of our guests, everything runs through KCN. So we've separated the ownership of the assets with the risks of the operation. So if there's ever a slip and fall, if we have an employee that crashes into somebody, which has happened, we've had employees hit guests in golf carts, whatever kind of crazy situation you come up with, they're going to go after KCN, the company that's operating the campground and employs all of the people there. And KCN doesn't own anything. It's simply a property management company. So in theory, we could shut that down, open up a new property manager the next day, enter into a new operating lease, and that protects our investors from any of the risks of the day-to-day operations. Ty's next question, do we have an active fund now? We have not done a fund yet. We have done individual like SPVs or single purpose vehicles, specific syndications to that one particular deal. So the ownership and the cap table for every one of our properties is a little bit different. And the reason we did that is, one, when you're starting out, it's really hard to start a fund because investors don't know you, you don't have a track record. And in a fund, they're really doing their diligence on you, not on the particular assets. And our goal has been, and what we're currently working on, is shifting that model to a fund or a new hold co where we raise a certain amount of capital within one ownership structure and buy multiple assets under that. May not be a traditional real estate fund, but would operate the same way, which provides a lot more flexibility and opportunity for us to spread the risk out. Financing becomes easier, cross collateralization of the loans and things like that. So to date, no, none of our 8 parks are in a fund. This deal we're working on right now will not be in a fund, and we hope that sometime next year we'll be able to raise the capital to set that structure up. All right. So what I wanted to share, if you guys are okay with it, if there's any questions, just speak up or put them in the chat and I'll try and get to them. But I wanted to show you the offering memorandum that we use, and this is for our current deal. This is a draft. It's not final yet. So some of this will change, but this is the most current version. We have not even shared this with our investors yet. So you guys are kind of getting a first look at it, not because I'm trying to solicit anything, but I wanted to use it as an example to show you what we're doing and how we're raising the capital. So in our offering memorandum, we'll go through what the property is, the specifics. So the property we have under contract is the Elizabethtown Hershey KOA, which is near Hershey Park, Pennsylvania. We bought the Gettysburg Battlefield KOA, which is about an hour away. We bought that earlier this year. So we really like that area for a couple of reasons. One, we have a park nearby, so there's some efficiencies there. 2, there's a major draw to that area. If you're not familiar with Hershey Park, it's 3 million plus visitors a year that go to that amusement park. But there's also other things in the area. Lancaster County is big for Amish country. But you've also got Pittsburgh, Philadelphia, Baltimore, DC, and New York City within a 3-hour drive. So population density is something that we look at. You've got anywhere up to probably close to 30 million people live within a 3 to 4 hour drive of this campground. So it's close to a lot of people. Anyone who wants to camp but doesn't want to do a road trip for a week, they can do a weekend trip to something like this. So that's one of the things we like about it. Purchase price is 5.25 million. We're going to end up raising, like I said, about 2.6 million of equity, and we'll use financing for the rest. And then we're raising additional capital as part of that 2.6 to do some improvements, expansion, site upgrades, deal fees, things like that. So over a 10-year period, we're projecting conservatively an 18+% IRR. I personally think it'll be much higher than that, but we're kind of sandbagging a little bit with some of our assumptions. Throw in some generic legal language about investing in real estate and all the risks and such. We get this from attorneys. And then we go into the highlights. So why do we like this park? We're 30 minutes from Hershey Park, 17th most visited amusement park in the United States. It's an attractive market. We talked about all the metropolitan areas around there. The campground itself, very highly reviewed, a lot of guests. It's been around for a long time. There's a substantial history of people coming. So we know that it has a strong customer base. This is an off-market deal. So over the years of us being involved in KOA, we've met a lot of other KOA owners. These particular owners came to us after a death in the family and said, we're ready to sell. And we had actually bought a park from one of their friends, and that transaction had gone very well. The friend recommended us. And so we're the only ones that had a shot at this. This has been owned by this family for 30 years. And so we think we got pretty good price on it. A very fair deal for us and for them. But it was off market through our network and reputation that we've tried to build over the last several years. We focus on value add, like everybody. That's not unique. But what we're trying to identify is parks that are good, that they're operating, they're profitable, they're good assets, but there's still meat on the bone. What else can we do with it? So can we add more sites? Can we upgrade the sites to be more premium? with a patio and a gazebo and a private dog park for people in their RVs. They'll spend more time, they'll pay more, they'll book further in advance, they'll have a better experience, so they'll leave a better rating. What can we do to take the park from where it is to that next level? This particular park has over the last couple of years been doing about 1.2, 1.3 million in gross revenue per year. It's open April through October, closes down in the winter. So essentially for $5 million, we're buying $1 million in revenue. And that's kind of the target we've been in. Our last 3 deals have all been around the 5 million purchase price, give or take, about 1.1, 1.2 million in gross revenue. This particular property is just under 50 acres. About 20 of that is available for future development. It has 127 RVs, 22 cabins, 11 tents. There's a pool, there's a mini golf, there's walking trails, there's a lot of outdoor games like life-size chess, playgrounds, volleyball, little bike track, stuff that make it exciting for guests and want to come. And what's cool about this one versus some of our other campgrounds is the average night that someone stays at this KOA is over 5 nights, which is a long time for a campground. So people are coming for essentially a week, which talks to one, the quality of the park, but also to the market itself. It's strong enough that people are going to want to spend a week there. So with our deals, the way the financing works is we're typically able to get a 25-year amortization on our loans. We have been able to get 30 years in the past. We underwrote this with a 7.5% interest rate. The deal we closed in September, we actually locked in at 6.99. And we had underwrote the deal at 7.5. So we think we'll be able to beat that. Just some of the specifics around this. Our debt coverage from day one is strong. We actually think that this is more of a 9 cap. And if you're not familiar with cap rates, let me know. We can go into that. But like I said, this is a draft, so there's still some things that are getting updated. And when we buy in year 1, we're trying to get somewhere in the 4 to 5% cash on cash return through distributions, which we start paying out quarterly after the second quarter that we've owned the property. So from year 1, even applying property management to a family owned park, there's a whole different expense structure. We're able to distribute close to 5% returns in year 1. And by the time we get to the end of the 10 years, we're closer to that 15%, give or take. So that's kind of the highlights of the deal itself, just to get investors kind of thinking about the specifics. And then we go into the property itself. What about it is appealing? What does it have? So we talk about the amenities, we talk about the camper nights, how many people are there. We look at the seasonality. When are we making the most of our revenue? What does that look like? We talk about the average night stay and why that is important. And then this is a map of the park, so you kind of see how big it is, what it's laid out at. Again, goes into some of the amenities, just trying to get investors familiar with what they're buying. And then our strategy. So when we go in for value add, we're looking at what can we do. So for this particular park, we kind of take a 2-phased approach. Is phase 1, what can we do in the first couple of years through minor upgrades, minor expansions, which is going to be kind of in that $500,000 to $750,000 of cost. And then a phase 2 would be a much larger expansion a couple years down the road, which could be, several $1-million project, at which point we would do a capital call. It'd be a whole separate type of underwriting. But for this park, we'll go in the first couple of years, we will upgrade all of the campsites to 50 amp electrical service, which is a big deal for RVers. We're going to add deluxe patio sites to existing RV sites at 14 specific sites. So those are going to be higher average daily rate. They're going to be the highest occupied site. They're going to book the soonest and have the longest length of stay in those particular sites. So that's really low hanging fruit. There's a seasonal aspect to this particular park. So because of its location, some people will rent a campsite for the entire season that we're open. So instead of churning through people overnight, we can say, we'll charge, and these are just hypothetical numbers. We'll charge $5,000. You can keep your camper in this particular site for the summer, and you come and go as you please. So there's an opportunity for that, and we can mix and match which sites make sense to do seasonal. And then pop pens is a big one where we have seen from day one of being in this, there are more people that travel with their pets than travel with their kids. And the people traveling with their kids, chances are they've got a pet too. And a lot of that is just the demographic of who's camping and why they're staying in campgrounds and not hotels. So we cater to that, and we'll do private dog runs that are at your campsite. So you could park your RV, you've got a patio where you can sit outside and eat. There's a grill, and we'll throw a fence around it with a little dog house and something so you can have your dog off leash running around. You don't need to worry about it because it's there with you. So those are really simple things, but have a really big impact. People love those. Those are a big attraction. So that's kind of our phase one strategy. It'll take us a couple of years to do that. And we go through and we look at how many camper nights were the 30 amp sites doing per year. So 96 times per year on average were these 30 amp sites getting booked. We upgrade them to 50 amps. On average, we should be able to get 118 nights. So we're increasing our occupancy by 22 nights a year. And that's going to translate into about $3,200 per site. So an electrical upgrade like that could be $2,500. Our ROI on that could be less than a year. And then we'll do that times 7. So that's really simple way of how we add value and drive up cash flow and forced appreciation of the property. And we'll go through in a little bit more detail of occupancy for what the sites look like, what the average revenue per site is. Again, all of this is just intended to get investors familiar with what they're investing in and why it's an appealing investment, right? If we say we're going to invest in 50 amp patio sites, well, if I look at this and say, well, there's 7 of those and they're 76% occupied during the season. And if you think about camping, a majority of it is weekend based. So 76% between April and October means we're getting a lot of weekday campers as well, but weekends are probably sold out. And those sites, on average, guests are paying $113 a site. And each one of those 7 sites is making about $16,000 of revenue a year versus just a standard 50 amp pull through site that's only 60% occupied, making $12,000, and people are paying $103. So it's just data to support our strategy of why we're investing in the capital improvements that we're doing and how this proves out that those investments make sense. Then we'll go through the market. We'll talk about what's nearby. This goes into the different metros, the population, tourism-based dollars, why people are going to that particular area. Because this is close to Hershey Park, the amusement park, we talk about that, how it compares when you look at, number 17 may not be super high on the ranking list, but based off the total number of amusement parks in the country, that's pretty high. But when you look at this, the top 10 or so are Disney and Universal, right? So we're not that far off of the big ones, right? You exclude those, we're in the top 10. So that's a big deal. Then we'll go into the specific underwriting, and this is really where savvy investors are going to spend most of their time. It doesn't take long for them to get familiar with the market, the strategy, what the property looks like, that field. That's not as important to the numbers. So we'll go through and we'll do our projections. What are we expecting growth to be? how do we support those growth assumptions? What are our expenses going to be? What are the margins and all of that? And we run that underwriting out on a 10-year period. This is only showing the first 5 years and then skipping ahead to 10 just for visual purposes. We have the full 10 years down below. But this is going to give you an idea of how much money this investment is going to make. And we explain some specific things like we do include our management fee, which for us is 7.5% of gross revenue. And because this is a KOA, there are franchise fees associated with it. So that's one that we call out. Then we get into our plan for the value add of what we're doing. And this is just the data supporting those numbers up above. And one of the common things you're going to see in any syndication or any capital raise is sources and uses, which is going to be a required disclosure. So how much money are we raising and how are we going to spend it? So this table here is really the key. We're buying it for $5.25 million. We're going to raise $426,000 for site upgrades, an extra $25K for deferred maintenance reserves, another $50,000 for just working capital reserves, just a buffer to make sure we have enough for payroll and inventory ordering and things like that up front. Then we put in our fees and other deal cost due diligence. So the total investment is $6 million, just a little over $6 million, but this is how it's broken up. So investors know where their money's going, how it's getting spent. We can be held accountable for that based off of what we're disclosing here. Then we go into the returns. So if you're investing, this is what the overall LP or limited partner cash on cash returns are going to look like. And then what we'll say is we'll break it down. We start with 100,000 as a suggested minimum investment. We'll come down off of that if we need to, but we typically try and target $50,000 to $100,000 for an investor. So if you invested $100,000 over a 10-year period, you would get just a little more than $100,000 back through distributions. When we sell it, there'd be another $173,000 of excess proceeds. So your total return on that $100,000 is $274,000. So that's kind of breaking it down, very simple math. Put in 100, you're going to get 374K back, which means you get return of your capital plus another 274 over a 10-year period. And then again, just more details about the property, the type of syndication, the hold period, how we do insurance. One important thing to note is because we are doing syndications and not just, hey, I'm going to partner with Jeff and Lexi because I know them and I want to get their capital and we'll do this together. We have passive investors. We're the active general partners. So the way we do it is we offer a preferred return. So the first 7% of all net proceeds go to our limited partner investors first. So we don't make any distributions until they get paid. That doesn't factor in the management fee, right? Our management company is getting paid its fee to run the park no matter what. But after all expenses, the first 7% goes to our LP investors. After that 7%, we do a 70-30 split. So they'll get 70% of what's left. We as the general partners will take 30% of that. And that's very standard syndication terms. You might see a higher preferred return or a lower preferred return or a different equity split. It's going to depend on the deal. It's going to depend on the market. But the last 2 deals we've done have been with this structure, and we're going to try that again this time and see if the market makes sense. What we may have to do if we come up short on our raise or we get a lot of feedback from investors saying there's better deals out in the market, I would like a 8% preferred return, we can adjust that. Impacts how much we make, but you just have to kind of weigh that in with whether or not you're comfortable with the returns that you're getting. This was something that took me a little while to learn, and I won't say struggle with it, but I still have to be conscious of it. Is too often we are so focused on making sure that our investors are happy and providing the best possible return for them. And the risk there is if all of the upside and all of the incentive is for them, and you as the person putting the deal together aren't getting paid enough for it to matter enough for you, you're not aligned with your decision making with your investors on that deal. So, for example, if we were to have a preferred return so high that we were never going to distribute 7% a year, that would mean let's say we set that at 10%, and we didn't think we would ever have a 10% distribution in a year, we would never get any distributions. So what is our incentive to hold that property for 10 years if we're not going to make anything off of it? Right. And so aligning your incentives with investor incentives means that everybody gets paid, everybody makes money, and investors will actually make more if we are incentivized to hold it and execute it and not just sell it because we're not making any money off of it. So that's something to definitely think about when you're structuring your deals. More information on the specific costs, where the money's going, how fees are getting done, a timeline of what we're doing. So we put this park under contract on October 18th, and we expect to close on January 31st. So we don't move super quick. There's a lot of time that goes into diligence in getting the loan and appraisal and survey and environmental study and infrastructure inspections. We have someone come out and look at all the electrical, run camera scopes down the sewers. We have to meet with the local city and county and make sure we understand the permitted zoning, and is the campground legal as is? Can we add to it? Can we not? Does the sewer system, whether it's private or city, does it have capacity to add more sites, et cetera? So we spend 3+ months on that. And typically for us, getting the loans approved is going to take a minimum of 3 months anyway. Then we give some background on us, our portfolio, who we are, why invest in us, what does our team look like, case study of what we've done in the past. So this is our track record. The first park we bought it for 1.25 million in 2018. It was doing 387,000 in revenue at the time. Sold it in 2023. It was doing 775,000 in revenue that year. And we sold it for 3.36 million. So it was just under 3x what we bought it for 3 years later. But to get to that meant we reinvested into it. There was about $450,000 of cash flow that we did not take out of the business, but we put back into it for site upgrades, expansion, store remodel, landscaping. Our playbook for our value add strategy started with this particular park, and this is what we're duplicating everywhere else. But this is why we love RV parks, because we bought it at a high cap rate. It was probably a 10.5 cap, and sold it for closer to an 8.5. So just that cap rate compression drove a ton of that value. And when we apply that logic across a portfolio of campgrounds, then the value, the exponential value that's added is significant. And that's why we're doing what we're doing. Is the thesis is we've got a very fragmented industry. And when I say fragmented, I mean it's essentially almost all of the campgrounds out there are owned by mom and pops, owner operators. There's very little institutional investing. There isn't one company out there that owns 30% of all the campgrounds, like in manufactured housing, right? There's no Wall Street private equity groups that own a substantial amount of this market. So we can go out and we can buy off market deals from mom and pops. When we combine all of those together, then we can take it to a big institutional buyer that wants to spend 200 million to get into this space, and we can package it all up and sell them to them, and they'll pay a premium for it. At least that's the hope. And that's really what our pitch deck looks like. We've got a couple of like ancillary slides talking about RV parks, the market itself, why we think it's interesting, kind of what I just talked about. Some more information about our current portfolio, the tax advantages of this. Again, another big reason we like this. There's really, really beneficial depreciation in RV parks compared to other asset classes. So you can invest even as a passive investor. You can basically make distributions and returns for years and not have any taxable income associated with those until you've used up the large depreciation carryovers. So it's a great way to offset other passive income. If you can, we talk about pre and post COVID and what that impacted our industry, which was very positive for us. Not everybody can say that. And then give our full 10-year projection. So this is the current version of our pitch deck. This is what we put out to investors. I won't say that it's perfect or that it's totally complete, but it's fairly detailed. And every time we do it, we end up adding something more to that that we learn. So that's that. I know there's some questions in here. Sorry, I couldn't see them for.
No, no worries. And wait, okay, first of all, this is what I'm talking about. So like campgrounds, RV, all that stuff to me is like, it's like mobile home parks were 3 or 4 years ago or whatever, when everybody's buying them. It's just like that asset class that's been around, but everybody's like, wait a second, what? And I feel like you're on that same niche. It's just because Brandon's been having those calls where people like cash flow Fridays. He does it on his podcast and different things, and then he has on the tribe too. He has those calls where people are bringing in different means of bringing cash flow, and I feel like campgrounds is right up there with them, man. It's super good. It's a super smart asset class to be in.
It's very similar, but it's lesser known. It just hasn't had the attention, and part of that is because it's harder to manage. Right, a self-storage unit, you can automate most of it. Campground, I mean, we could have at some of our parks, we have 18 employees, and we could have 100 people checking in on any given day, and 20 to 30 cabins that need to be cleaned. And so that has been a barrier to entry for a lot of investors, and that's where we looked at it and said, here's the opportunity. Right, if we can solve that puzzle, we can build a team to run that. Then we can provide an opportunity for people who want to invest passively in this, that don't want to buy and move into one of the cabins and run it themselves, because there's really just not a whole lot of opportunities to do that.
Yeah, and that was my question. We'll go into the other questions here. Was I asked like, why KOAs? It seems like everything you have is KOA. So is there a reason for that? And then would you were just saying like some of your parks you can have upwards of like 10, 15 employees or whatever. Is that become more of a business now, or is that still pretty passive? So I guess
it is. Yeah, I'll take the second one. It is 100% a business. We've got at our corporate level, we now have 12 of us. We've got 4 partners. One of them's a general manager. We have 2 regional managers. We have a controller, marketing manager, construction project manager, an executive assistant. Like, we have built out that team to operate the day-to-day because it is very, very hands-on. So that, yes, it's a challenge. Today I had a call from our HR person and one of our regional managers because there's some drama going on with employees and former employees, and how do you handle that, right? Like, it is very much a business. And to your first question, why KOA? So when I got into this, I had no idea what I was doing. Never worked for myself, never run a business, never done any of that. And so I really liked the idea of being part of a franchise that provided support and training, and there was someone I could call. I didn't have to figure out how to set up a website, how to do marketing for my brand, how to manage the day-to-day, right? All the tools and resources came packaged with that. So that's why I started with a KOA, and it was right park, right time, right deal, right seller financing. So all of that was a plus. And we've grown within KOA because of our network. The time we've spent meeting other owners, participating in conventions, networking at KOA events, and we've built up a little bit of a reputation as good people to work with. We know what we're doing. And so, the last 3 deals we've had have been from that relationship within the KOA system. So it's kind of been organic. It's not that we don't want to do other things or other brands or have an independent campground. We're actually specifically trying to do that. But we have so much good deal flow within the KOA system that comes to us inbound that we haven't had to look outside of that yet. And we do really like the brand. I mean, it is the number one recognized camping brand. You look at the numbers for Hershey, for example, 60+% of their campers are KOA rewards members. So they have a very loyal camping base. Whereas an independent park, if they don't know that park, they may or may not really have a desire to stay there or to return. So there's some benefits of that, but there's costs for it as well.
Yeah, yeah. No, that's I don't, like I said, for me, yeah, maybe a business like you're saying, absolutely, but once you get the structure in place, like I feel like you guys have, yeah, you can handle some calls here and there, but again, just for the asset class and being what it is, I still feel like it's definitely, if you can get the people behind you, it's something to get into for sure. So we'll run through a couple more questions here. Obviously, we're gonna run a little bit long. Sorry, that's for me running my mouth in the beginning. Apologize. So Cody, what is your philosophy on the speed of acquiring more and more, considering the timeline of executing the planned value add?
Cody, I would buy as many parks as I could today, but we've got a couple constraints. Is one, I'm not comfortable buying something that I don't feel like we can operate and provide a good return to our investors. So we have to make sure we don't just buy for the sake of buying and then take our acquisition fees and then let the park suffer, right? So it's important for us that when we buy it, we can actually do a good job running it. And that's why we have invested in our corporate team and put the people in place that we can scale. So we've got ahead of the curve a little bit with that. I think honestly, we could probably buy another 4 parks without hiring any additional personnel at our corporate level. And then we get to that kind of 12 park range. The idea is one of our regional managers wouldn't be overseeing more than 6 particular properties at one time. So then we hire another regional manager. There's a couple other roles we want to look at. But the biggest constraint we have is capital. We have way too much deal flow to come through for us to act on because we can't raise the capital for it. So that's a part of why we are moving at the pace that we're moving. We bought 2 parks this year. We'll close 1 in January. I had hoped to do 4 parks this year, so we're a little behind. But a lot of that came down to being able to raise the capital that we want. But in terms of what incentivizes me or my philosophy around the speed is, as I mentioned, this is a fragmented industry. At some point, it won't be. There will be a consolidation. There will be institutional buyers that will come in and will gobble up large portfolios. And when that happens, cap rates and pricing on campgrounds are going to become much more challenging. So my goal is to build our portfolio to that scale before that consolidation happens so that we get to benefit from the cap rate compression and that arbitrage between what we're buying it at and what we can sell it for. So the more we buy now, the more money we'll make later on. It doesn't mean that 10 years from now you won't be able to get good deals and make it, but if I buy a park today for 5 million, in 10 years I ought to be able to sell it for 10 or 12 million. If I buy that same park 6 years from now, it's probably going to cost me 7 or 8 million, and then I may only be able to sell it for 10 million, right? So there's more money to be made getting in early and building up to scale in advance of this asset class becoming more popular.
Amber, let's see, how do you come up with your deal structure, and do you pass through the depreciation to the investors?
Depreciation does pass through to investors through K1s, and it's all based off of your ownership percentage. So as an example, we bought a park in 2022. Now, those of you familiar with bonus depreciation and what's happening with that under the current tax law, I'm not going to get into current politics and what that might look like in the future, but going back to 2022, you could write off 100% bonus depreciation in year 1 for assets or assets that fell into a 15-year or less useful life. So you buy an apartment building, if you don't do a cost segregation, you've got a asset that has to be depreciated over 30 years, 40 years, whatever. With RV parks, we're buying not very valuable land, so not much of the purchase price goes to that. And there's not a whole lot of buildings. So most of the value is tied to assets that you can depreciate and write off quickly. So in 2022, we bought a park for 6.25 million. And that same year, we wrote off $5 million of depreciation, and that passed through to our investors through their K1s. So you could have invested $100,000 and taken a $400,000 loss in year one. Now that's changed because the amount you can write off has been reduced, but that's the way that it works.
Gotcha. Let's see. People are asking for a copy of your pitch deck.
So here's what I'll do. Like I said, the pitch deck's not finished yet. It's a draft version. What I will do is when we have it ready, which hopefully will be next week, I will post in or have Jeff. I can do it, I guess. I'll post in the RPC chat a link to our investor portal where you can register, and then you can access all the details of the deal, including the deck, any of our previous deals. All that information will be there.
Nice. Awesome. Very cool. Let me make sure I don't have any other ones. Lead generation is mostly off market and relationships.
That's yes. There are a handful of brokerages that specialize in RV, and we've made relationships, connections with those brokers. So they know what we're looking for. They send us emails, they call us, they bring us deals all the time. There are websites specific for RV parks, like Zillow, but specific to campgrounds and RV parks. So we'll look at those sometimes. But like I said before, most of the deals that we're acting on are just through our relationships. Now, there's a lot that you could do to build up a pipeline without those relationships. And there's a lot of deals out there. I won't say that they're all good. They may not all pencil, but lead generation is not as hard as you would think for this asset class.
Nice, dude. I appreciate this. Seriously, this has been really, really good. And I love that you ran us through that pitch deck, showed us all that stuff, because there is a lot of value in that. And especially for again, for me, like I said, we're just making an offer on one right now, and to wrap my head around it, my wife actually, I think she's on. Are you on this call? Yes, she is. She's done all that work, but still, like, to wrap your head around all that is a lot. So it's really cool that you walked us through that, explained all that. That's super, super helpful. So, dude, totally appreciate you being on, and y'all, thank you for being here. I will say one more time that we have that thing that me and Mr. Kevin are working on here, and that is that camping event. So if anybody is interested in that, we're going to take a select number of people. It's only going to be about 20 people is what we're looking at right now. Okay. So the first 10 people that sign up are going to get a deluxe cabin. That'll go right away to those first 10 people. And then after that, there's additional cabins. They're just not, they don't have like a fridge and a bathroom. You'd have to use outside of that. But and then
when he says outside, he doesn't
no, I don't mean like outside
going
on a
in the
tree.
woods.
Yeah, no,
Oh,
I
I was
know
about
what
to
I mean.
say, am I
Out-
roughing it? I mean, I got an army background, but just
yeah,
help a
yeah.
girl out here, man.
We've got nice bathhouses. They're just shared. Some of our
Yes.
cabins have bathrooms and kitchens in them. Some of them are more rustic and beds, and then you use the shared bathhouses.
Okay, that's what I meant. Yes. So, but the whole thing's gonna be awesome. And again, like I was telling you guys earlier, this is like family style camp. So if you have kids, grandkids, whatever, you can bring them. If you have dogs, right, Kevin? Can we bring dogs, cats?
Absolutely.
Cats?
Dogs are preferred.
Okay.
If I could bring my dog, I would, but Arkansas is too far, and my wife, she wouldn't approve of me paying for a airline ticket for my dog. She thinks I'm already too obsessed. So.
I gotcha. I gotcha. But yeah, so that's the whole deal. And we're going to be putting all this information out. We just put it up here first. So we're working with Better Life on it as well, and they're going to be promoting it as well. But like I said, it's going to be limited to like 20 people. So sign up as soon as we get it out there, sign up, and it's all going to be through Kevin and I. We're going to handle the whole thing and get everybody set up, like the food, all that stuff. So if you have food allergies and stuff like that, we'll work with you on that and as much as we can too. So, and again, if you have an RV and you want to, and you're local and you can drive there with your RV, or you happen to be camping and you want to go check out the area, and meet up with some cool people. Have a bro sesh, have a bunch of ladies meet up, whatever. It's all good. So we're just looking forward to getting some people together and having some fun and getting the kids involved and all that. So anyway, that's that. You guys stay tuned for more information. I'll be posting it on the WhatsApp group. This is recorded. So Saturday is usually when I get some time to work through the recording and post it on our WhatsApp group. It goes on my YouTube channel. And obviously you can follow me on Instagram. Kevin, your Instagram is what?
It is Camping Kevin KCN.
Camping Kevin KCN. Yeah.
I'll
And then
put
you
it
also
in
have
the-
one for KCN too, right?
Yeah. Yeah, if you want to reach out or you have any questions, you can hit me on the WhatsApp or through Circle, or through that Instagram. My email. Actually, I'll put my email in here too. We'll make sure that this gets out, but happy to go through any questions, anything else I can do to help you guys.
Yeah, dude, we totally
Or if
appreciate
you want to help me, by all means, I need it. So
He's looking for some capital. So if people are out there wanting to do invest. I mean, bro, if I had the money, I'd be in it because it's got me excited. It's pretty awesome. A good asset class. So yes. So anyway, either way, you guys want to invest or you just want to learn more about it or whatever. Kevin's a huge contributor, right? And a lot of you on here are, and I appreciate everybody on Raising Private Capital, throwing out stuff and helping out people. Like I said, we're just about at a year. So it's pretty impressive to like see 100 and almost 90 something members that are on and active and being on these calls and stuff. You guys are awesome, like seriously awesome. And I hope I get a bunch of you there at this camping event because that's what I want is my people around. Not like saying that they're not all my people, but you're my people. So you get what I'm saying. So anyway, listen, guys, I appreciate it. Thank you all so much for always jumping on these calls. Not next Thursday, but the Thursday after. We're gonna have another call, we got another guest. So look forward to seeing you guys then. Kevin, once again, thank you, sir. Really appreciate it.
no, thank you guys. I appreciate it. Great questions, great comments. Appreciate the feedback.
Cool.
Thanks for
All right.
letting me ramble.
And me too. You guys take care. Y'all have a good weekend.
All right. See you guys.
See you guys. Bye.